The trading floor goes silent. Not the orchestrated quiet of ceremony, but the eerie hush of collective realization. On screens across 3 continents, a number appears that shouldn't exist anymore. The 10-year Japanese government bond yield, the bond that has been artificially held near zero for nearly a decade, breaks free. It climbs, first slowly, then with gathering momentum, like ice cracking beneath the surface of a frozen lake. In Tokyo, Frankfurt, and New York, traders watch their models fail in real time. The math that worked yesterday doesn't work today. And in that moment, suspended between the old rules and whatever comes next, everyone knows the game is changing. The central banks have run out of road. The great performance, the careful theater of independent monetary policy, is ending. And what comes next is something the modern financial system was built to prevent, something we swore would never happen again. Debt is about to become money. Not gradually, not theoretically, but inevitably and soon. The only question left is, when the transformation begins, will anyone admit what they're watching? Here's what they won't tell you in the official statements, in the carefully worded press releases, and the reassuring testimony before congressional committees. We've been here before. The difference is that this time, we know what we're doing. In the 1940s, when America needed to finance a war that would cost more than the entire economy's output, the Federal Reserve simply held interest rates down. The government borrowed, the Fed bought the bonds, and the whole apparatus kept functioning because everyone agreed it had to. They called it yield curve control. They didn't call it what it was: the transformation of government debt into permanent base money. The suspension of the fundamental rule that says central banks must not finance governments directly. That experiment ended in 1951, replaced by the doctrine of central bank independence. The idea that monetary and fiscal policy must be kept separate, that the creation of money must never serve political ends. For 7 decades, this principle held. It became the foundation of modern macroeconomics, the sacred boundary that separated stable currencies from inflationary disasters. But principles like levies only hold until the pressure becomes too great. The pressure building now is unlike anything in that 70-year history. Global public debt has crossed $100 trillion. Not in some distant projection, not in a worst-case scenario, but right now, in 2025, as a documented fact. That number represents nearly 100% of global GDP, a ratio not seen since the aftermath of World War II. But here's what makes it different. We're not emerging from a war. We're entering a permanent condition. The debt didn't accumulate because of some temporary emergency that we can grow our way out of. It accumulated because of structural forces that aren't going away. Aging populations demanding more healthcare and pensions, infrastructure crumbling from decades of deferred maintenance, the climate transition requiring trillions in investment, and a global security environment that demands higher military spending. Every major economy faces the same calculus: too much debt, too many obligations, too little political will to raise taxes or cut spending. The IMF's projections showed debt continuing to rise through the end of the decade. In the United States, interest payments on the national debt now exceed defense spending. In Europe, countries that struggled to meet fiscal rules before the pandemic have given up even pretending to try. In China, the property sector collapse has pushed local government debt to levels that make American deficit hawks look quaint. And in Japan, where this story really begins, the debt-to-GDP ratio exceeds 200%, a number so extreme it should have triggered a sovereign debt crisis years ago. It didn't, because Japan discovered something that terrifies every orthodox economist. If your central bank is willing to buy enough of your debt, if it promises to keep interest rates low enough for long enough, the traditional rules about debt sustainability simply don't apply. You can borrow almost indefinitely. You can run deficits that would bankrupt any normal country. As long as the central bank stands ready to convert that debt into money, as long as it maintains the fiction that this is temporary and reversible, the system keeps functioning. Japan didn't just bend the rules. It proved they were negotiable. For nearly 8 years, from 2016 to 2024, the Bank of Japan operated under a policy called yield curve control. The mechanism was simple in concept, revolutionary in implication. The central bank announced it would buy unlimited quantities of Japanese government bonds to keep the 10-year yield at around 0%. Unlimited. That word matters. Traditional monetary policy involves the central bank adjusting short-term interest rates or buying a predetermined amount of assets. Yield curve control inverts the logic entirely. Instead of setting a quantity and letting prices adjust, you set the price and provide whatever quantity the market demands. If bond yields try to rise above your target, you buy more bonds. If markets test your resolve, you buy even more. The result is that the government can borrow at essentially zero cost, regardless of how much it borrows, regardless of its debt level, regardless of any normal consideration of creditworthiness or sustainability. The central bank has made government borrowing costs a policy choice rather than a market outcome. To anyone who remembers the lessons of monetary history, this should sound like a nightmare. It violates the most basic principle of sound money, that someone must bear the cost of government spending, either through taxes or through the risk premium demanded by private lenders. When the central bank removes that cost, when it promises to buy whatever quantity of bonds necessary to keep rates at its chosen level, it has effectively abolished the market discipline that keeps government from spending without limit. And yet, for years it worked. Japanese inflation stayed low. The yen didn't collapse. Government bond yields remained stable. Markets, initially skeptical, came to believe that the Bank of Japan could maintain this policy indefinitely. The academic papers got written, the new models got built, the orthodoxy adjusted. Perhaps the thinking went, the old fears about debt monetization were overblown. Perhaps in a world of low inflation and excess savings, central banks really could finance government deficits without consequence. That comfortable theory shattered in 2022 when inflation returned to the global economy. Not the gentle 2% that central banks target, but the kind of inflation that forces ordinary people to change their behavior, that dominates political discourse, that makes central bankers wake up at night remembering the 1970s. In the United States, Europe, and most other developed economies, central banks responded by raising interest rates aggressively. They had to. Their mandates, their credibility, their entire institutional legitimacy rested on their ability to control inflation. But Japan couldn't follow. The Bank of Japan was trapped by its own policy. With the government's debt at over 200% of GDP and the central bank owning nearly half of all outstanding government bonds, raising interest rates would have explosive fiscal consequences. Every percentage point increase in rates would add trillions of yen to the government's annual interest bill. More importantly, allowing yields to rise would mean admitting that yield curve control had failed, that the years of promising unlimited bond purchases to maintain zero rates had created a dependency from which there was no escape without triggering a fiscal crisis. So while the Federal Reserve raised rates from near zero to over 5%, while the European Central Bank ended a decade of negative rates, Japan held firm. Yields stayed pinned near zero. The cost was predictable and brutal. Currency traders, seeing Japanese yields frozen while the rest of the world's rates soared, sold the yen relentlessly. It fell from 105 to the dollar to 140, a depreciation not seen in decades. Every economics student learns that interest rate differentials drive currency values. Japan had become a textbook case study playing out in real time, except the textbook scenario was supposed to force a policy change. It didn't. The Bank of Japan kept buying bonds. It expanded the band within which it would tolerate yield fluctuations, giving the appearance of flexibility while maintaining the essential commitment. Government borrowing costs would stay near zero, market forces be damned. Here's where the story turns from concerning to inevitable. What Japan proved, what the entire world watched unfold between 2016 and 2024, wasn't that you could run yield curve control temporarily in an emergency. It was that once you make government borrowing costs a matter of policy choice rather than market determination, you can never really stop. Because stopping means admitting the truth. The debt is unsustainable at market rates. The government cannot afford to borrow at the rates private investors would demand. The central bank, despite its claims of independence, despite its inflation mandate, despite all the carefully constructed legal barriers meant to prevent fiscal dominance, has become an instrument of government finance. This is the definition of debt monetization that textbooks use, when a central bank permanently expands the money supply to finance government spending. Not temporarily, not as part of normal monetary operations, but permanently, with the primary goal of reducing the government's financing costs. You can dress it up in different language. You can call it quantitative easing, or yield curve control, or balance sheet operations. You can insist that it's all reversible, that the central bank might sell these bonds back into the market someday. But if everyone knows that day will never come, if the debt burden makes reversal impossible, if attempting to reverse would trigger a sovereign debt crisis, then what you have, stripped of euphemism, is monetization. Japan admitted as much when it finally, grudgingly, began to exit yield curve control in 2024. The policy lasted 8 years. During that time, the Bank of Japan's balance sheet grew to over 130% of GDP, compared to about 20% for the Federal Reserve and the European Central Bank. That's not the size of a balance sheet you accumulated doing normal monetary policy. That's the size of a balance sheet you accumulated financing a government. Now zoom out and look at what happened everywhere else during those same years. The COVID pandemic hit in 2020, and governments around the world did what they had to do. They spent enormous sums to keep their economies from collapsing. Furlough schemes, expanded unemployment benefits, direct payments to households, loans to businesses, all financed by debt. Trillions upon trillions in new borrowing, added to debt loads that were already high from the financial crisis a decade earlier. And who bought this debt? Central banks. The Federal Reserve's balance sheet more than doubled, from $4 trillion before the pandemic to nearly $9 trillion at its peak. The European Central Bank expanded its holdings from 2 trillion euros to over 7 trillion. The Bank of England, the Bank of Canada, central banks across the developed world all did the same thing. Massive purchases of government bonds, supposedly temporary, supposedly part of crisis management. Except they never reversed it. Oh, they talked about reversal. The term quantitative tightening entered the lexicon. Balance sheets began to shrink marginally. But look at the numbers. Global public debt is at $100 trillion and rising. Central banks hold unprecedented quantities of their own government's bonds. Interest rates, which soared in 2022 and 2023 to fight inflation, are now coming back down again because the alternative, keeping rates high enough to truly control inflation, would make the debt burden unbearable. This is the trap. This is the moment where theory meets reality and reality wins. Every major economy is now facing the same impossible choice that Japan faced. Either maintain high enough interest rates to keep inflation under control, which will make government debt costs explode and potentially trigger a fiscal crisis, or accept that monetary policy must accommodate fiscal policy, that central banks must help finance their governments, that the old rules about independence and inflation targeting have to bend. There's a term for this in economics, fiscal dominance. It means the moment when fiscal policy, not monetary policy, becomes the binding constraint on what central banks can do. When governments are too indebted to afford higher rates. When political pressure to keep financing costs low overwhelms the central bank's price stability mandate. When the institutional arrangements that kept monetary and fiscal policy separate start to break down, because continuing to separate them would crash the system. The indicators are everywhere, if you know where to look. In the United States, where the Federal Reserve prides itself on independence, political pressure on monetary policy has intensified dramatically. Former President Trump explicitly called for the Fed chair's removal over interest rate decisions. Current debates about the Fed's mandate increasingly question whether fighting inflation should take precedence over avoiding a recession or supporting fiscal sustainability. The institution that spent decades building credibility around its independence finds that credibility tested every time rates rise and debt service costs increase. In Europe, the debt crisis that nearly destroyed the Eurozone a decade ago never really got resolved. Greece, Italy, Spain, Portugal, all the countries whose bond yields spiked and threatened their ability to stay in a common currency. They're still heavily indebted. France, supposedly the fiscal anchor alongside Germany, now runs deficits that violate European Union rules and has seen 5 governments collapse in 2 years over attempts to implement budget cuts. The European Central Bank created something called the Transmission Protection Instrument, a mechanism to buy the bonds of highly indebted countries if their yields rise too much. In plain language, a tool to prevent market discipline from forcing fiscal adjustment. In the UK, the brief government of Liz Truss collapsed in 2022 after bond markets revolted against unfunded tax cuts. But notice what that episode revealed. The Bank of England had to step in with emergency bond purchases to prevent yields from spiking further. The government changed, the fiscal plans got reversed, but the underlying truth remained. Britain's debt burden is large enough that sudden increases in yields pose a systemic risk. The central bank must stand ready to intervene. Even in Germany, the fiscal hawk of Europe, the conversation is shifting. The constitutional debt brake, once sacrosanct, is now openly debated. Defense spending needs, infrastructure investment, the energy transition, all of these demand fiscal expansion that existing rules don't permit. The question isn't whether Germany will loosen its fiscal constraints. It's when and how much. If stories like this fascinate you, consider leaving a like. It helps bring more hidden chapters of economic history to light. This isn't just about debt and money. It's about power, about who controls the economic system and whose interests it serves. The shift from monetary dominance to fiscal dominance represents a profound change in the political economy of capitalism. For 4 decades, from the early 1980s to the early 2020s, the dominant framework said that inflation was the primary economic danger and independent central banks were the primary defense. This framework gave central bankers enormous power. They could raise interest rates and trigger recessions if they thought inflation threatened. They could ignore political pressure because their mandate was technical, not political. They answered to inflation targets and economic models, not to elected governments. That era is ending. Not because central bankers want it to end, but because the math doesn't work anymore. You cannot maintain central bank independence when government debt is so large that independent monetary policy would cause a fiscal crisis. You cannot tell voters that their pensions and health care must be cut to maintain bond market confidence, when the alternative is to have the central bank buy more government bonds. The political economy inevitably shifts, which brings us to 2026, and why that year specifically marks the turning point. Several factors converge. In May 2026, Federal Reserve Chair Jerome Powell's term expires. The next appointment will happen amid continuing debates about the Fed's independence and role. Every major economy will be in the middle of its normal debt issuance cycle, but with financing needs amplified by years of deficit, spending, and now higher interest costs on the existing debt stock. The European Central Bank faces personnel turnover, with multiple board members' terms ending, creating opportunities for governments to reshape the institution's leadership toward a more accommodating stance. In Japan, while yield curve control has officially ended, the challenge of managing an exit from decades of ultra-loose policy without triggering a bond market crisis continues, and the lessons of that experience are being carefully studied everywhere. Most importantly, 2026 is when the fiction becomes harder to maintain. The gap between what central banks say they're doing, independent monetary policy focused on price stability, and what they're actually doing, helping to finance government spending, becomes too obvious to ignore. When Japanese bonds were held at zero for 8 years, it could be framed as an experiment, a unique response to unique circumstances. When the Federal Reserve holds trillions in Treasury securities that it cannot sell without crashing bond markets, when the European Central Bank stands ready to buy the bonds of fiscally troubled members, when central bank after central bank finds reasons to keep rates lower than their inflation mandates would dictate, the pattern becomes clear. This is the moment when the transformation becomes explicit, not a crisis, not a sudden collapse, but an acknowledgement. The great performance ends. The vocabulary changes. Maybe they'll call it modern monetary coordination or fiscal monetary integration, or some other phrase that sounds technical and non-threatening. Maybe they'll emphasize that this is different from historical episodes of debt monetization because we have better models, better communications, better guardrails. Maybe they'll point to Japan and say it worked there, inflation stayed low, the currency stabilized, see, the old fears were overblown. But make no mistake about what's happening. Governments are financing themselves by issuing debt that their central banks buy and hold permanently, expanding the money supply in the process. That is the definition of monetization. The question is never whether it will happen. The math makes it inevitable. The question is only how it gets justified, how the institutions adapt, how the public comes to accept what would have been unthinkable a generation ago. There are real risks here. The reason central bank independence became orthodoxy in the first place is that debt monetization historically led to inflation, currency devaluation, and economic instability. Weimar Germany, Hungary in 1946, Zimbabwe, Venezuela. The cautionary tales are numerous and terrifying. When governments can finance themselves by printing money, when the constraint of having to borrow from skeptical investors disappears, when monetary and fiscal policy merge, the incentive structure changes completely. There's no discipline, no mechanism to force difficult choices about spending and taxes. Just the printing press, available whenever politically convenient. The counterargument, the one that will be made repeatedly as this unfolds, is that we're different. We have inflation targets. We have institutional safeguards. We have credible central banks that will withdraw accommodation if inflation rises. We have learned from history. Maybe that's true. Maybe this time really is different because we understand the mechanisms better, because we can target specific inflation rates rather than just letting the money supply expand without limit. Maybe the Japanese experience shows that debt monetization under the right conditions, with the right commitments, doesn't inevitably lead to disaster. Or maybe we're just rationalizing the inevitable. Maybe the institutional safeguards will erode once they become inconvenient. Maybe the commitment to price stability will weaken when the alternative is admitting that government finances are unsustainable. Maybe we're not smarter than history. Maybe we're just about to repeat it with more sophisticated language. The thing about crossing a line is that once you've crossed it, it's very hard to go back. Once governments get used to financing themselves with central bank money, once the political system adjusts to debt without discipline, once the public comes to expect that the government will never face a true fiscal constraint because the central bank can always provide more money, you fundamentally change how the system works. And that change might be irreversible. Because the alternative, restoring central bank independence, letting interest rates rise to whatever level the market demands, forcing governments to cut spending or raise taxes to sustainable levels. That alternative requires a level of political pain that no democratic system will voluntarily accept. So we move forward into this new world. We tell ourselves it's different from past episodes of monetization because we're doing it carefully, scientifically, with proper oversight. We create new frameworks and models to explain why the old rules don't apply anymore. We adjust our expectations about what counts as price stability, what level of inflation is acceptable, what central banks should target. The transformation happens gradually enough that it never feels like a crisis, just a series of small adjustments to changing circumstances. Until one day you look around and realize, we crossed the line. Debt became money. The rules changed. And there's no going back. The final question, the one that determines whether this is a story of pragmatic adaptation or catastrophic mistake, is this: what happens to prices? Because that's ultimately what money is, a claim on real resources. When you expand the money supply, when you finance government spending by creating new money rather than taxing or borrowing from private savers, you're increasing the claims on resources without increasing the resources themselves. Standard economics says that should be inflationary. More money chasing the same amount of goods means higher prices. Except Japan monetized debt for years and inflation stayed low. The United States, Europe, and others did massive quantitative easing, and for a long time inflation stayed subdued. The models that predicted runaway inflation were wrong. That's what makes this moment so uncertain. We have one set of historical experiences saying debt monetization leads to inflation and currency collapse. We have another set of recent experiences saying it doesn't, at least not immediately, at least not inevitably. We have theoretical arguments on both sides. And we're about to find out, on a global scale, which view is correct. The optimistic case says that in a world of aging populations, high savings rates, technological deflation, and slack labor markets, you can monetize more debt than historical models suggested. That the inflation we saw in 2021 to 2022 was a temporary supply shock, not the beginning of a sustained inflationary period. That central banks can finance governments on a much larger scale than previously thought possible without losing control of prices. The pessimistic case says we're building pressure behind a dam. That every $1 trillion of debt monetized, every year that fiscal dominance continues, every compromise of central bank independence adds to the inflationary potential. That it takes time for inflation expectations to de-anchor, for people to lose faith in currency, for the feedback loops to start. But once they do, they accelerate rapidly. And by the time you see clear evidence that inflation is becoming a problem, it's too late to prevent the spiral. Which view is right matters more than almost any other economic question we face. Because if the optimists are correct, then we've discovered a kind of free lunch. Governments can spend more, invest in infrastructure and climate and social programs, all financed by central bank money creation, without suffering the traditional consequences. That would be transformative, a fundamental expansion of what fiscal policy can achieve. But if the pessimists are correct, if we're just experiencing the lag before the inflation appears, then we're setting up conditions for economic chaos that could take decades to resolve. This is where the story becomes personal, where abstract discussions of central bank balance sheets and debt sustainability collide with your life, your savings, your future. If debt becomes money on a permanent basis, if fiscal dominance becomes the new normal, that changes what money means. It changes what savings means. It changes the implicit contract between you and the currency you hold. Every dollar, euro, yen, pound in your bank account is a claim on future resources. Its value depends on trust. Trust that the currency will maintain purchasing power, that the institutions managing it will resist the temptation to inflate it away, that there are real constraints on money creation. That trust has been the foundation of the modern monetary system since World War II. The shift happening now tests that trust fundamentally. You're being asked to believe that governments can borrow without limit as long as their central banks buy the debt. That this is different from historical episodes of monetary financing because we have better institutions, better models, better commitments. That the rules that applied to Weimar Germany and Zimbabwe and Venezuela don't apply to advanced economies with credible central banks. Maybe you should believe that. Maybe it's true. Or maybe you should look at your savings, your pension, your salary, and ask, what are these claims actually worth if the institution that issues the currency is permanently financing government spending? What happens to the value of money when money and debt become the same thing? These aren't abstract questions. They're questions about whether your retirement savings will retain their value, whether your salary will keep pace with real costs, whether the economic system your future depends on is stable or built on fictions that are about to be exposed. The transition to fiscal dominance, the permanence of debt monetization, doesn't announce itself with a crisis. It happens through a series of accommodations, each one justified in the moment, each one supposedly temporary, until the cumulative effect is a system that works completely differently than it did before. And by the time you realize the change has happened, by the time the consequences become clear, the damage is done. So what would you have done if you were in their place? If you were the central banker in 2026, facing a government with unsustainable debt, a political system demanding lower interest rates, and a public that expects services but won't accept taxes? If you were the finance minister looking at deficits that keep growing, spending demands that keep increasing, and bond markets that require your central bank support to function, do you hold the line? Do you insist on rules that might trigger a crisis? Do you tell the truth about the fiscal arithmetic even though the truth is politically unacceptable? Or do you do what's necessary? Do you cross the line between monetary and fiscal policy because not crossing it would be worse? Do you tell yourself this is different, this is managed, this is under control? Do you become part of the greatest monetary experiment in modern history, knowing it might end in disaster, but hoping it ends in something sustainable and new? History will judge. The inflation numbers, the currency values, the economic outcomes of the next decade will reveal whether this generation of policymakers found a way to manage debt that previous generations couldn't imagine, or whether they just delayed a reckoning that will be more severe for the delay. But history's judgment doesn't help you now, facing the decisions you have to make about your own money, your own future, your own trust in the system. Tell me in the comments. What would you have done? What are you going to do? And if you crave more stories that test the limits of truth and power, more analysis of the economic forces reshaping our world, subscribe. Because the next chapter of this story might just change how you see not only economics, but the very nature of value itself. The transformation has begun. The only question is what comes next.